Hello, everyone. This is Lindsay at KHI. Welcome and thanks for joining our webinar on this Monday. Lynn is on the road today, so I get the pleasure of introducing Cassandra with BASE, and she is going to be talking about HRAs for small business owners. During the call, feel free to type in your questions. We'll probably take those at the end of the call. That way we're not interrupting, and a lot of questions may be answered during the call as well. So I'm going to hand it over to Cassandra so she can discuss this benefit strategy with you.
Great, thank you. Hello, all that are on the webinar. Again, my name's Cassandra. I've given a few webinars here for KHI, and today we're going to talk about HRAs. We're going to talk about two different kinds of HRAs today. An HRA, if you're not aware, stands for a health reimbursement arrangement, and both kinds of HRAs that we're going to talk about are really aimed at employer dollars given to employees tax-free for certain benefits. So just a little brief history. Obviously, the Section 105 HRA has been around since 1954, and now in 2016, we had a new HRA that was passed that was within that 21st Century Cures Act, and that's been very helpful or given small employers another option for offering benefits to employees. And that's what we're going to talk about first, is that new legislation that passed. It's called a QSE HRA, Qualified Small Employer. And that legislation did pass in December, late December of 2016. And what that means is that HRA allows a small employer to reimburse employees for their individual health insurance premium and out of pocket if they want through an HRA. Okay, the second type of HRA we're going to talk near the end or the back part of the webinar is what's called an integrated HRA. That's going to be if a small employer, maybe a group of one that you wrote a group healthcare plan with. We're going to talk about how that can help those family-owned, HRAs that did get group. So I don't want anyone to get confused. The first part of our webinar is the QSE HRA, and this is for small employers who do not have group health care. And then the second part is going to be the integrated, and that's going to be those that do have group health care. Okay, so let's just get started on the QSE HRA. Sometimes we'll get a phone call and someone will call it QSERA, or but it stands for Qualified Small Employer. And if you are between basically 2 and 49 employees, that you are under 50 FTEs, you qualify for a QSE HRA. And it allows an employer, maybe for some reason they just didn't want to go into group healthcare, or for one, maybe sometimes the owners are sitting on grandfathered plans and it doesn't benefit them, so they just choose not to get group. They can, as a small employer, get an HRA, a QSE HRA, that will reimburse their employees for their individual health insurance premiums and out-of-pocket medical expenses. The employer sets the benefit design, so they might say, we've seen a lot of smaller amounts. We do a lot of these HRAs where an employer will say, I want to reimburse my employees $200 a month for their individual premiums and their out-of-pocket medical expenses, maybe a copay, deductible, a prescription, and they just want to give a small benefit of $200 a month. We'll talk about benefit maximums because there are some with this type of HRA. And the important thing, the advantage to setting up a QSE HRA is it's tax-free to the employee when it runs through the HRA, and it's 100% deductible to the employer as a business deduction when you have an HRA in place and you're offering benefits. So a couple of the nuts and bolts of the plan are, obviously an HRA is employer dollars given to an employee for premiums and out of pocket. So it's benefit dollars from an employer. You cannot have, and we get this question a lot, you cannot have a salary deduction or any other employee deductions through payroll. Okay, so you used to be able to do this and you can't anymore, where let's say a small employer has 10 employees and they all had individual plans. You used to be able to take your own premium out of their paycheck before tax through a Section 125. You cannot do that. So, and that's still the same. That has not changed. You cannot do that any longer. So if you have any questions, I wanted to mention this as we're talking about a QSE. If you have questions as they come up, type them in, because we're going to answer QSE HRA questions before we move on to the integrated. So back to the webinar. If an employer, they cannot have a group healthcare plan in place to have a QSE HRA. So a small employer, if they want to offer benefits, has options now. They can either offer benefits through a QSE HRA, saying I want to reimburse my employees a month, a certain dollar amount a month for their premiums, or they go to group. But you can't have a group healthcare plan. Maybe I own a business and I have 10 employees and I have a group healthcare plan and only 5 of my employees have opted into my group healthcare plan. Well, I can't reimburse the other 5 for their individual health insurance premiums tax-free to them. So you can't have a group healthcare plan in place and offer a tax-free reimbursement for individual plans. You have to do one or the other. Okay, so the employees, they have to have an individual health plan, and you can, back in the day when we had HRAs, like before the Affordable Care Act, you could have what we call carve-out plans, meaning you could say, my supervisors, I want to reimburse, $400 a month. My office workers, I want to reimburse $200 a month. You can't do this through this type of HRA, okay? And we get this question a lot as well. If employees can be on a spouse's group healthcare plan through their employer, and they can still receive the HRA funds for out-of-pocket. So one of the requirements for an employer to reimburse their employees for their premium is that employee has to have a minimum essential covered plan. They have to have a MEC plan. We're seeing a lot of Christian healthcare ministry plans or maybe some short-term health plans. Those are not MEC plans. So that's not a premium that can be reimbursed through the QSE HRA. But if that employee does have meet that minimum essential covered plan, they have a MEC plan, they can be reimbursed tax-free by their employer for their premium. Now, if I have, a business and they have 10 employees and 2 of them are on their spouse's group healthcare plan, well, they meet the MEC requirement. They're on a minimum essential covered plan, but they could be reimbursed through my HRA for a copay, a deductible, a prescription. They couldn't be reimbursed for their premium, but they could be reimbursed for their out-of-pocket medical expenses. Okay, that was a lot of information. So if you have questions about anything that was just discussed here in that slide, feel free to type those in. This is just basically a slide it's just educating that the average American spends, I think, at least $10,345. That statistic came from the Centers of Medicare and Medicaid Services, but that just means that anytime an employer is offering benefits, because what happened before when the Affordable Care Act came into place and they made that rule that an employer cannot reimburse for individual premiums or you're subject to that $100 per employee per day penalty. What happened was a lot of employers went to group, obviously, to offer benefits. But if they didn't, they just decided maybe I'm just going to gross up wages to my employees. Well, that employer is paying payroll taxes on those dollars and the employees are paying taxes on those dollars. So when you can run it through an HRA, a qualified small employer HRA, that becomes 100% tax deductible to the employer. And then there are some kind of requirements with this type of HRA. There are 3 notices that have to be given to employees for this type of HRA. And the 3 notices are very important. There's penalties that are attached if you do not provide notices to your employees about this type of HRA. And a lot of it has to do with, if an employee receives a subsidy. So one of the notices is obviously the benefit limit, but one of the notices are letting the employee know that if they do receive a subsidy on the marketplace or exchange for their premium, they have to report the amount that the employer is providing them through the HRA to the marketplace or exchange, and it would likely affect their subsidy. So that's giving those notices and the importance of the employer to provide the notices. And we provide the notices to the employer. They don't have to do any of that. We'll give them the notices, but they do have to give those to their employees. And that kind of just takes the liability off the employer on, reporting any amount of an HRA to the marketplace or exchange is now really passed on to the employee. And then the second requirement for this type of HRA is what we call attestation forms. And basically, each employee that is going to be on the HRA has to sign an attestation form, meaning they have to attest that they have a minimum essential covered plan. So that is the one requirement the employee has to have to be a part of the HRA is they have to have a MEC plan. So the attestation form, it really just states that you're going to say who in your family, you and who in your family has a MEC plan. For example, let's say I'm an employee of Lindsay's and she is offering me an HRA. Well, let's say I'm married, I have a MEC plan, but my husband has chosen just to be uninsured for some reason. Well, I have to sign that attestation form that I'm the only one in my family that has a MEC plan. So really, I'm the only one that can be reimbursed for my premiums and out of pocket. My husband could not turn in a copay or a prescription. He does not meet the MEC requirement. So that helps us at BASE, that's required form, to let us know who we are approving claims for in a family. So if there's any questions, an employer can reimburse an employee for 2018 up to a maximum of $5,050, and they can reimburse a family up to $10,250. So those are the maximum amounts that can be reimbursed through an HRA for premiums and out of pocket. A small employer, they can reimburse, they can say, hey, I just want to help my employees out with their premium only. I don't want to include out-of-pocket medical expenses. That's okay, you can do that. But an employer could not say, I just want to reimburse my employees for out-of-pocket only. You can't do that. You have to include the premium. So this type of HRA, we've seen a lot more than we thought we would, especially even here in Iowa, where a lot of times maybe those small employers, maybe they're all family-owned farms or that were just grossing up wages in the past because they couldn't reimburse for individual premiums. Maybe they're sitting on grandfathered plans. Moving to a QSE HRA can at least provide some business deductions to the business and tax-free to the employee. And we're seeing a lot of mid-range employers, 25 and under. You can have an QSE HRA under 50, but we're seeing the majority of them are, under the 25 employee size business because, as you guys know, a lot of them would move to group if that's, a better option for them. Do we have any questions about the QSE HRA?
Yeah, Cassandra, I'm not seeing any questions coming in as of yet, so you're doing a really good job.
Not a problem. So if one pops up even about this type of HRA, Remember, the QSC HRA is for a small employer who does not offer group health care, okay? And so if those pop in, we'll still answer them at the end of the webinar, but we are shifting gears. I don't want anyone to get confused about which type of HRA is for what. And so we're moving gears into if you have clients that have a group healthcare plan in place. So if they have a group healthcare plan, they cannot have a QSC HRA. And there are many different types of HRAs, an integrated HRA, but I wanted to focus today on what are you doing with all those groups of one or family-owned groups that you wrote. And I know there has been a lot. And so that's been a big bulk of what the group healthcare in December and January were. So how can an HRA for those small groups or those groups of one, family-owned groups, how can it benefit them to have an HRA? And it's called an integrated HRA because it's integrated in with your group healthcare plan. But if you wrote a lot of small groups of one or family-owned, you know, maybe husband-wife or family-owned businesses that went to get a small group healthcare plan, their premiums already are, as you know, are business deductions because it's a group healthcare plan. They can pay that group healthcare premium right out of the business account because it's group. You can do that, and when you do, it's a business deduction. But what are you going to do with all their out-of-pocket medical expenses? Their co-pays, deductibles, prescriptions. They can put an HRA into place while they are reimbursing those that are in the group healthcare plan for their own out-of-pocket medical expenses. And so this list is huge, and it includes, you know, chiropractor. I mean, I can send out a list of what they call Section 213D expenses. But if you're a family-owned business, or maybe you're a small group, maybe you have a group healthcare plan and you have 4 employees, and everyone opted out, and the only ones that opted in were family, yourself, it's your own business, you could be having that HRA for yourself. Because the only time you can have, when you have group health care and you put an HRA into place, you can only offer that reimbursement for those that are on your group health care plan. So why not educate your client and let them know that an HRA is available to them where they would not be paying any taxes on their out-of-pocket expenses. They're going to become business deductions. So it's 100% deductible from a state, federal, and self-employment tax standpoint. And I know you guys are writing a lot of HSA plans, and that's fine. So I just wanted to talk briefly about the difference between an HSA and an HRA. So if someone has an HSA qualified plan and they go put money into an HSA account, they are going to save the state and the federal taxes on that amount that they put into their HSA. If that small employer and it's just them on the group healthcare plan and they pick up an HRA, they're going to save federal, state, and the additional 15.3% FICA on those out-of-pocket medical expenses. So an HRA might be an option. You can have an HRA and an HSA. I don't want to get into that. If you have specific questions about that, call me because I don't want to confuse. I don't want to get into the details of that, but you can have both. But sometimes it might be more beneficial for an employer to have an HRA and not put money into an HSA just so that they have that additional 15.3% FICA savings. Obviously, let's say I own a small business and I have 5 employees and my husband and I are W-2 employees in our own business and 2 employees opted out and it's just my husband and I on the small group healthcare plan. Well, that HRA would reimburse us from the business to us as W-2 employees, tax-free to us for our out-of-pocket expenses. All right, don't know why my key is stuck. There we go. This is just an example. On an average, out-of-pocket medical expenses is around $6,000 annually. Now, obviously, deductibles are higher than ever. Premiums are higher than ever. Everything's higher than ever right now. So we see a lot of HRAs, and that's a typical family out-of-pocket year is $6,000. And so I just was doing the math on what a small family, if you had an HRA and it was just yourself on the group healthcare plan, what that would save you a year. Federal tax rate now is 12%. That's new. And state tax rate here in Iowa is 5%. And then that self-employment tax rate is 15.3%. So if you take all of that, you're going to save 32.3% on all your out-of-pocket. So that helps, tremendously on not paying taxes on out-of-pocket. You can include dental and vision in there too. It's not, it is integrated in with your health care, but you can include all Section 213D expenses. So you can include your dental and vision in there as well. So partnerships are the one area, I don't want to confuse anyone, but if you were a partnership in a group healthcare plan, you'd have to have a W-2 employee. Usually partnerships are not W-2 employees unless your spouse was a W-2. So sole proprietor partnership still could participate in an HRA, though it's a little more rare for a partnership, but any C corporation or S corporation, all those types of business structures can participate in an HRA. And we have HRAs for all sizes of businesses. If you have group healthcare and you want to offer any type of benefits to your employees through an integrated HRA, you can do that. But I just wanted you guys to know or be educated on the fact that all those small groups of one could really save your clients money by having an HRA in place because you're offering benefits. And that's a lot of times what owners want. If there's a way for them to offer some sort of tax benefit to themselves, why not do that? And that's how those, let's say I have a small group, I have 5 employees, everyone's opted out, and I have an HRA for myself, but then I hire an employee and they opt in. Okay, maybe 8 months down the road, I have an HRA and I've been reimbursing, our family for our own out-of-pocket. Well, 8 months later, I hire an employee and they need my group healthcare plan and they opt in. I would have to offer them that same benefit limit to them, or I would cancel my HRA. So if you have that type of a lot of times those groups of one, you guys all wrote them, it's just themselves in the plan, and likely that's how it's going to stay for a long time. But if that situation did occur where an employee opted in, you might want to then cancel your HRA because you don't want to offer that reimbursement to an additional non-family employee. So obviously with an HRA, just on kind of, administration-wise, we provide a summary plan description, a plan document, so that you have a compliant plan in place, and that can all be done through BASE. And then lastly, just want to mention that we do write those ERISA wrap documents. An ERISA wrap document is a Department of Labor required document, and it would be applicable to any employer that has group benefits. So if you pick up a group healthcare plan, group dental, group vision, any type of group benefits, the Department of Labor states that you have to provide a summary plan description to any participant in a benefit. We get a lot of questions many times about how about those groups of one, how about those all family-owned groups that went into small group, do they fall under those Department of Labor requirements? And yes, they do. The Department of Labor is not deciphering a family W-2 employee to a non-family W-2. If you offer any type of group benefits, you are required to have a summary plan description, provide that to all participants, and then obviously if you were to get an audit and have not done that, that's where that $110 per employee per day penalty comes into place. So I know we talked near the end about small groups or groups of one or family-owned groups. They are also subject to ERISA. Premium-only plan wouldn't necessarily apply to them because obviously employers paying 100% of the premium in that type of situation. So our ERISA wrap documents, I know probably most that are on the webinar here, we've written an ERISA wrap document for a client of yours, but it provides that summary plan description. It provides them with a plan document. Both of those are required for groups. And then, I guess I already mentioned that, regardless of the size of, you could have one employee on the group healthcare or 100 employees on the group healthcare. What makes you fall under those Department of Labor requirements if you need an ERISA wrap document or if you don't is if you have any type of group benefits. If you are an employer offering benefits, you fall under that Department of Labor requirement to have that ERISA wrap document. So that's really all I wanted to talk about today. This webinar is a little shorter than normal. I told Lynn that that would be the case just because I didn't want to throw in a bunch of other types of HRAs. I wanted to throw in what was most applicable maybe to you right now after you just wrote a lot of groups of one or family-owned groups, having that as an option for an HRA. And then the first part of what we talked about today was the QSC HRA. So if you have a client that just didn't want to make that move to group, or they're just wanting to offer benefits some way to their employees, that's that QSC HRA. Are there any questions?
Hi, Cassandra, it's Lindsay.
Hi.
I'm not seeing any questions come in, but if anybody does have any questions, I mean, they can feel free to reach out to us here at KHI, myself, Allison, Nakia, Tricia, and we can get those questions onto you if they do come up with something after the webinar.
Absolutely, and my email is right on the screen there, and my extension is 235. So if you have a particular client that maybe you're wondering, would this be beneficial to them, or a group of one or family-owned group that you wrote and wanted to discuss any specifics, it'd be better that you give me a call and we can talk about that as well.
All right, great. Well, thank you, Cassandra, for taking time today.
No problem.
Going through that information with us.
All right, you guys have a good day.
You too, thank you.
Okay, bye.
Bye.